Two illustrations from the same carrier. Same product on the cover. Same monthly premium. One of them has a $2 million death benefit. The other has a $500,000 death benefit. At age 65, the second one has roughly twice the cash value of the first. Same money in, different money out. The difference is in the design, and the design is almost never explained. What's this design supposed to do anyways? An IUL pulls double duty, both for death benefit and tax advantage cash accumulation, which is accessible through policy loans. If you want the death benefit, you want one design. If you want retirement income, you want a different design. Same product, different mechanical setup. The mechanics determine the outcome. What this person was sold on. Put $1,000 a month into this for 25 years. At age 65, you'll have tax-free retirement income plus a death benefit for your family. Best of both worlds. The sentence isn't wrong. It's also not honest about the trade. The death benefit you got priced into the policy comes out of your cash value every month for 25 years in the form of cost of insurance charges, or COI. More death benefit, more cost. With more cost, less cash value. Three things that made this broken. First, the death benefit was sized for commission, not for need. Commission on life insurance is largely a function of the relationship between premium and death benefit. A policy with a higher death benefit to premium ratio generally pays more on the front end. If the goal is a cash accumulation, the death benefit should have been sized to the IRS mandated minimum non-MEC corridor, the smallest death benefit the contract can legally carry while keeping its tax advantage status. Most retail IUL sales don't do that. They size the death benefit larger, sometimes much larger. The reason is rarely your retirement income, but rather their commission. Second, the cost of insurance compounds against the cash value. Every month, the policy charges the cost of insurance based on the death benefit. That cost increases as you age. The charge comes out of your cash value. In a death benefit heavy design, the cost of insurance in the later years is pretty substantial. The same crediting rate produces material less cash value because the credit is being applied against a smaller principal. The cost of insurance ain't the rest. Year 1 looks fine, year 5 might look fine, and year 15 is where the gap starts to show. By the time you plan to draw income, the cash value is behind the cash value funded version of the same policy. Third, the fix later is expensive, sometimes impossible. Some carriers allow you to reduce the death benefit later in the policy's life. That can lower the cost of insurance going forward, but the cost of insurance you already paid is gone. You can't get it back. And in some designs, the death benefit triggers a modified endowment contract test, converting the policy from a non-MEC to a MEC tax treatment, which kills the tax-free loan strategy. That was the whole reason you bought this in the first place. Hope is not a strategy. Neither is hoping the fix will be available later. Designed for the income on day one. So what should this look like? If retirement income was a goal, here's the design conversation that should have happened. Start with this question. How much annual premium can you commit to for funding over the period? Call that the premium budget. Next, we're going to size the death benefit to the minimum non-MEC corridor for that premium. That's the smallest death benefit the policy can carry without losing its tax treatment. Smaller death benefit, less cost of insurance, more cash value over time, smaller commission for the agent. Use a death benefit option that increases over time, typically option B in most carrier language, which reduces cost of insurance as cash value builds. And we're going to run the illustration at multiple rates, both the maximum AG 49 guidelines, the 5%, and the guaranteed column. Confirm the income story clears the math at 5%. And we're going to only fund when it's been stress tested. The same product, different design, different retirement. How can you tell if your policy has this problem? There's 3 checks that are going to take about 20 minutes with your illustration. First, we're going to find the initial death benefit on page 1. Divide it by the annual premium. If the ratio is well above the IRS minimum for the non-MEC, your policy is carrying more death benefit than the income strategy needs. Second, we're going to find the cost of insurance projection table. Read the cost of insurance in years 10, 20, 30. Higher death benefit means higher cost of insurance in later years. That's a drag on your cash value. And we're going to ask whether the policy uses death benefit A or level, or option B or increasing. For cash accumulation, option B in early years, switching to option A later when funding is done, is often more efficient design. So what does this review actually involve? If you own an IUL and you're not sure whether it was designed for income or designed for a death benefit, DM me the word design. I'll send you the Above the Limits IUL guide that walks through the design lever in detail. Most reviews start the same way. We open the illustration, we find the death benefit to premium ratio, we talk about the original goal actually was, and from there, the conversation tells you what you have.